And then, total imports now is 7 only. Previously was 12. Why? This is production 7, but consumption is only 14. This is the demand. This maintains. This is the relevant, because this is the world price, and this is subsidy goes to the producers only, does not go to the consumers. So this is total consumption 14, total production because of subsidy, production subsidy has increased from 2 to 7 because of the subsidy. Here, 400, subsidy is 25. So we draw this line. 400 here, this is how we do it. 400, now 25, we know subsidy is 25, we draw this. Okay, 7. Given to us, 25, I'm repeating. So we draw this line. 7. So this is new production, total production. I mean, because of subsidy. So 7 produced, consume 14. So 7 now is the total imports. Reduced from 12 under free trade. Now 7. Net price for producers is 425. That's the net price for producers. They get 425, which is the price of 400 paid by consumers. Consumers still pay 400 because this is the relevant intersection, world price and what the consumers, the demand. So 400 paid by consumers plus 25 by the subsidy. So 425, the price of 400 paid by consumers plus 25 subsidy. So total cost to US government is 25 times 7. That part, 25 by times 7. by times 7. 7 times 25. This is total cost to the US government. Okay? 25 times 7. That rectangular. So A is a redistributive effect. From consumer lost it, but it goes to producer. So doesn't matter, still within the country. You can calculate that. B is the protective effect. More costly domestic output are allowed to be sold. More costly domestic output are allowed to be sold. So B is the protective effect. And in fact, that's the deadweight loss. B is deadweight loss. That's with subsidy. Now, B, panel B. This is export subsidy. That was domestic production subsidy. This is export subsidy to increase export. So assume United States is a small producer. Under free trade, this is demand, supply, free trade. This is world price. Just now we're talking about imports. Now we're talking about exports. World price. So under free trade, price is 5. Producers, this is supply. So supply curve, okay. Produces 8, and this demand curve consumes 4. So consume 4, produces 8, 4 is exported by United States. 4. Producers, 8, because supply curve. Consume, because it is demand curve, 4. So 4 is exported. Suppose United States government pays $1 on each unit of wheat exported. That allows firms to receive world price to receive $6 with $1 subsidy, export subsidy. Receive $6, which is world price plus the subsidy, $1 here, so 6. World price of 5 plus $1 subsidy, so $6 per unit. So domestic producers would not sell in the United States for less than $6. So as a result, prices go up from 5 to 6. Why this domestic exporters or producers will not sell in the United States any price below 6? Because they can sell it outside, overseas at 6. Why sell it under $6 inside the country? So that's why the price must increase to 6 in the United States because of the export subsidy. So quantity purchased in the United States falls. This demand falls from 4 to 2. This new line, this demand. Consumption falls from 4 to point B, 2. Quantity supplied rises from 8 during free trade with export subsidy, rises from 8 to 10 because of subsidy. So production increases, total export rises. Yeah. Previously only 4, now rises to, this is consume, 2 only, consume. Why consume? Demand. Supply here, production, 10. So 8 is now exports, total export. It has increased from 4 to 8, the total export. Consumers lose A and B because previously under free trade, I cannot reach. Under free trade, this is consumer surplus. This, okay, free trade. This free trade, consumer surplus is here. Now consumer has lost A and B with this line, with subsidy, A and B. Consumer lost A and B. You can calculate that at $3 million. So domestic producers gain A, B, C, A, B, C. Domestic producers got it. Because previously, this is producer surplus. Now with the new line, with subsidies, increase A, B, C. I'm short. Too short for this. So producers gain A, B, and C, which is calculated at 9 million. Cost to taxpayers is B, C, and D. This rectangular here is the cost to taxpayers. Taxpayers pays for the amount of export here. 8 and amount of subsidy. So B, C, and D cost to taxpayers. With B and D as dead weight loss. This here easy to understand. Consumer, D paid by taxpayers, but doesn't go to anyone. Go to the subsidizing the high price, the export subsidy. Taxpayers paid for that, but doesn't go to anyone except for the higher prices collected when they export. They collect now 425. Wait a minute. Yeah. That was there. 6. 425 is there. $6. So, deadweight loss. And B is another deadweight loss. Consumer has lost it. Even though producer gets it. But that consumer lost gets to the producer, goes to the producer, but the consumer pay tax on the portion of that. So there are two deadweight losses. And in fact, you can look at this differently actually. This is not in the portion of that. Not in the portion of that. Because this is the new line. And yet, this is part of taxpayers' money that goes to subsidize the export. So B and D is the deadweight loss. So let's compare. Which one is worse? Quota is the worst. Tariff has two deadweight losses. Tariff, deadweight losses here. Quota is worse. Tariff is bad also, but not as bad as quota. Now, production subsidy, domestic production subsidy, only one side of the deadweight loss. So, less damaging than tariff. Because one deadweight loss only. However, export subsidy has two deadweight losses. Similar to tariff. Bad also. But less bad with domestic production subsidy. But still bad because free trade is the best. So let's read here. A government subsidy granted to import competing producers, production subsidy, leads to increased domestic production and reduced imports. The subsidy revenue occurring to the producer is absorbed by producer surplus and high cost production protective effect. A subsidy granted to exporters allows them to sell their products abroad at prices below their cost. However, it entails a deadweight loss to the home country in the form of the protective effect and the consumption effect, two deadweight loss. So next, okay, this is still subsidy. Just notation from that. Whereas domestic production subsidy is granted to producers, or we've done this, both granted to producers, export subsidies, okay? Previously, domestic production subsidy, the notes. And this is export subsidy. Let me read if I hope I don't miss anything. Whereas domestic production subsidy is granted to producers of import competing goods, and export subsidy goes to producers of goods to be sold overseas. For both, net price received by producers equal price paid by purchasers plus the subsidy. And subsidy revenue redistributed in the form of producers' surplus. Export subsidy, higher output and prices for exporters, higher exports, lower domestic consumption. We just seen this is just to review. So domestic producers gain at the expense of domestic consumers and taxpayers. So decrease in consumer surplus, increase in producer surplus, taxpayers bear the cost of export subsidy. So to deadweight losses in the case of export subsidy. Next, subtopic dumping. So, a form of international price discrimination occurs when foreign buyers are charged lower prices than domestic buyers for identical products, also selling in foreign markets at a price below cost of production. So, forms of dumping sporadic. Firms dispose of excess inventories below price by selling below price. Predatory. Producers temporarily reduces price, charge abroad to drive foreign competitors out of business. Persistent dumping goes on indefinitely to maximize economic profits. So let's look at international price discrimination. When we're talking about dumping, actually, producers charge more at home with less competition and more overseas to compete. Submarkets demand conditions must differ. Different demand elasticities. Firms must be able to separate submarkets, prevent arbitrage resale of goods at higher prices. Markets easier to separate internationally. High transportation costs, trade restrictions. So let's look at this here. South Korea is a less elastic market. Canadian, more elastic market. This is sub-market of South Korea, sub-market of Canada. This is total market. Total markets add horizontally from both South Korea and Canadian markets. Koreans firm maximize profit by selling 45, which is with the principle of marginal revenue equals marginal cost. Marginal revenue equals marginal cost. So 45 units with average total cost of 300. Average total cost 300. Yeah, 40 points. So total cost is 30,500 total cost. Non-discriminating, if non-discrimination. Korean firms sells at 45, sells 45 at 500. Optimal output where horizontal line intersects demand schedule at 500. So sells 35 to Koreans at 500. Sells 35. This 500 line sells 35 to Korean market, the demand in Korea, and sells 500. Sells 10 in the Canadian market. So the profit is that amount, 17,000 plus 5,000 in the Korean market and Canadian market. So minus total cost of this one. So profit is 9,000. Now, with price discrimination, dumping. So charge higher prices to Korean buyers, which is less domestic demand, lower prices to Canadian buyers, more elastic demand, without additional cost. So add marginal revenue equal marginal cost, and where horizontal line intersects marginal revenue schedule in each submarket. So at marginal cost and marginal revenue, and that intersects the marginal revenue in each of the market, marginal revenue. So, sells 25. This is the line. Marginal cost equals to marginal revenue. We maintain that principle, which is that intersects with the marginal revenue in each submarket. So sells 25 in the Korean market, but at high price of 700. Not here. 700. This is the line of profit maximization. Marginal revenue equals marginal cost. So sells 25 at 700. the price in Korean market and sells 20 at marginal revenue and demand, this demand, extraction with marginal revenue, demand at 400, sells 20 units at 400 in the Canadian market. So the profits now has become 12,000, which is an increase in the profit, previously 9,000 because of price discrimination. So anti-dumping duty levied when U.S. Department of Commerce determines foreign merchandise being sold less than fair value. U.S. International Trade Commission determines LTFB imports are causing or threatening material injury to the domestic industry. Anti-dumping duties imposed in addition to the normal tariff. So the margin of dumping, that's the amount by which foreign market value exceeds United States price. Foreign market value, two definitions. Price-based dumping occurs when foreign firms sell goods at price in the US below their home price. Or cost-based definition, used when price-based definition cannot be applied. Cost of manufacturing merchandise plus general expenses, at least 10% of cost of manufacturing, plus profit on home market sales, at least 8% of manufacturing cost, plus general expenses, plus packaging and shipment to the United States. So case of Whirlpool, let me check my recording. This is a story about Whirlpool. In 2011, Whirlpool filed anti-dumping and anti-subsidy petitions against Samsung and LG. 2016, Whirlpool filed again. 2017, United States International Trade Commission approved Whirlpool's petition for safeguard protection. And there's another story here, so we can just skip. So anti-dumping laws. Supporters claim such laws are needed to ensure level playing field by offsetting artificial sources of competitive advantage. Critics note that although protected industries gain, consumers lose more and economy as a whole therefore suffers net losses. Should average variable cost be the yardstick for defining dumping? Economists argue that fair value should be based on average variable cost rather than average total cost, especially when domestic economy experiences downturns, temporary downturns in demand. So under competitive conditions, firms price goods at average variable cost. Anti-dumping laws punish competitive behavior. So US firms selling at home not subjected to same rules. Should anti-dumping law reflect currency fluctuations? In exchange rate can cause a foreign producers to dump according to legal definition because of the exchange rate. Are anti-dumping duties overused? Now, nations small and large bring anti-dumping case leading to retaliation. In many cases where imports were determined to be dumped, they would not have been questioned under the same country's antitrust law, competition law. Government procurements, so other non-tariff barriers. So there are so many tariff barriers, subsidy and so on, quotas, the main one. Others are government procurements, policy. This is example here, Buy American First. So I'm going to skip this. Social regulations to correct variety of undesirable side effects that market ignore: health, safety, and the environment. So corporate average fuel economy, passenger cars, light trucks. So Europe has a cow over hormone-treated US beef. Or you can put a stop for this, what I call this, genome modified wheat or soybean. Sea transport and freight regulations. U.S. shipping companies serving Japanese ports complain of highly restrictive system of port services required to clear every detail of visits with Japan's stevedore company. Dock workers available only 18 hours made U.S. goods more expensive in Japan. In 1997, U.S. and Japan, on the brink of trade war, reached an agreement to liberalize port services. Other non-tariff barriers. I consider this as new non-tariff barriers. New. Number one, why they are new? Because they are connecting, tying, making a connection between trade policy and non-trade issues. To connect, to tie trade policies with non-trade issues. Number one, for example, this eco-labeling in Europe of tropical woods. You know, in Europe, you go to the shop to buy woods. The woods are labeled if they come from tropical countries. You know, European people are educated with the protection of environment. They know this every wood coming from tropical countries. They think of orang-utan. You know, demolish of trees, you know, felling of trees. So orang-utan in the jungle have no place to stay or to live. So they say, I'm not gonna buy tropical woods. That's the impact of eco-labeling. So in a way, eco-labeling is a way of stopping imports coming into the country. So it's a barrier. Non-tariff barrier, new non-tariff barrier, new types of new non-tariff barrier. Labor standards, suppose child labor or labor from prisons. The United States used to complain about this country, I don't want to mention, that used child labor. Child labor, you don't pay money, or you pay very little. So it's not fair. The prices of goods coming to the United States, United States complain that it's so cheap because you use child labor. Another country used, United States complained that this country, that another country uses laborers from the prison. Laborers from prison, you don't have to pay a lot of money to them, the wages. So prices good, imports are coming because of low cost. So technical standards, for example, catalytic converters to reduce smoke from car exhaust. So there's a way using technical standards to stop imports of cars coming into the country, into the United States. So technical standards. Health and safety products, if agriculture and so on, and medicines must have the USDA, United States Department of Agriculture approved. And connecting with human rights. Suppose that country, trample on human rights. So this another country will put tariffs or restrictions on imports from that country. So we just learned about non-tariff barriers. So thank you for watching. Assalamualaikum warahmatullahi wabarakatuh.